let's go back to this point that Didier made in your opening remarks about the sort of pressure on pricing, set against the sorts of things we're hearing about, you know, banks having to spend so much money on compliance, and obviously, you know, almost to the extent where they're not able to invest in the new technology they need for the new services to add the value, which would help with pricing, if you see what I mean.
Exactly. No, I think pricing has come down for two reasons. One is the competition that we have seen between the different banks and the appetite to go for this type of business. I think the second one is obviously regulatory, and SEPA is a good example of it. I mean, this did not help in terms of getting the price high. And as such, when you look at the corporates and they look at GTS operations, really for them sometimes it's difficult to differentiate the different bank solutions. And then they take the shortcut to say, well, if there is no real differences, then let's go for the cheapest one, which I don't believe is the right choice. So I think the challenge for the bank is first to be able to differentiate, and second, to be able to provide value-add services. Now, these value-add services, it can be around reporting, it can be around seamless integration. More and more corporates from medium size are also looking after, I would say, solutions that didn't exist for them a couple of years ago. SWIFT, for example, is something which is more and more seen for medium-sized corporates. So how can you help not only more the big ones of these worlds to go into these kind of operations, and, but also the smaller parties of this world? And the problem will be that before developing new solutions for your corporates, which is going to be value-add services, you want to make sure that there is a business behind it. And for me, there are two questions. Is it just to protect my existing market share, or is there a business that they're going to be willing to pay for extra services and as such increase my margin compared to the other banks? And that's a difficult question. I don't know how the bank can do that or how they do proceed with these questions.
Well, let's ask them. Brian, you can go first. Didier says all the customers just thinks all bank services are the same and don't know how to differentiate between one or the other.
So I think there's a fundamental core of moving money from A to B, which is a commoditized product.
Yeah.
And every bank that has a transaction banking business of some shape or form offers that. I think how you interface with your customer at a technology end, and we've talked about some of that, connectivity is critical to creating value. And you can make it an efficient experience for your customer at the connectivity end. You have a much better chance of making it cheaper for the customer, not because you're charging less, but because their costs are less, and that's an important part of the equation. But equally, they want to have a low operational risk solution, and it comes back to the question we talked about earlier about operational risk. You may well be able to charge a higher price if you've got great connectivity and you have a lower operational risk. So I think there's the front end bit. There's also, we've come back to some of the other points we've raised, if you can help your customer manage their risks better, and that's their interest rate risk and their currency risk, for example, interest rate risk around the liquidity that they bear within their payments world, or their currency risk that they bear within the settlement of their operational flows. These are all areas where you add value to the core payments, which is just moving money from A to B. And that's in the competitive space. That's not in the cooperative space. How individual banks do that will distinguish them between other banks. And that's how you'll create value, and that's not the area for cooperation. That's the area for red-blooded competition to make sure that you can beat, the other person that's bidding for this mandate.
Okay, all right. Well, that's RBS's value-added solutions. Karen, what are Standard Chartered's?
Well, I will add a couple of those to that because I agree with everything that Brian has said. I think a couple of things. Many corporates, in fact, I would say the majority of corporates are not just in one country. So the fact of having multi-market consistency and the ability to look after a transaction at both ends can provide enormous advantages to corporates. So I think thinking about how you can have consistency across a large number of markets, particularly across a region, because often large corporates are buying at minimum a region at a time. Yeah. Being able to fill out a whole region is very important. The second thing is the advisory knowledge. The knowledge of how things work in countries, how things work from a regulatory point of view, keeping them abreast of things. So the advisory ability, that the regulations and the ways payments work in different countries are changing every day. And the clients rely enormously on very quick knowledge on that. The third thing is, as we said before, you can't separate the payments from the credit side of things, and looking at the whole supply chain of corporates, having the risk appetite and the credit knowledge to deal with local corporates and to be able to serve their buyers and suppliers around the world is also becoming increasingly important as it's linked together. So 3 different points of view.
All right. And so Didier, do you see corporate clients paying for those kinds of services we've just heard about?
Yeah, I think exactly when they go typically for a regional approach, they would like to have a bank in front of them who is able to serve all of their needs in that region. But if you look at, for example, Europe, there is not one single bank today that can serve all of the services across the wide Europe. So typically you see 2 things, is that certain banks for certain areas, like you said, are going to compete against each other. Then certain banks, or let's say the same bank in another area, will then cooperate. And I think we use a word, which I think is a completely new word, but they say it's a co-petition model. So what does that mean? It's in certain markets you're going to cooperate, in others you're going to compete. And to give you an example, we typically see 3 different areas. The first one is the one you mentioned, is around geographies. And you have plenty of alliances that are well known in the market. They're going to say, if you go in that type of market, we will not compete. And the business that are going to come to us and they're going to ask for business for these countries is going to go to you. So non-compete agreement. And it's very transparent toward the corporates because they need to open accounts with the other counterparty. They need to have the service with the other counterparty, etc. That's geography based. Then in between, you're going to have the products. It could well be that one of the bank is in a country but cannot serve certain typical products. Yeah. And typically the products could be around cash collection activity, where you need a branch network, or check collection activity. And they're going to outsource that service to another bank or to the post network or something like that. But still, they're going to cooperate on that specific product area and competing in the same country on the other specific services. So it's a little bit more at the tension there. And then you have the third area, which is around the services, which is completely then not seen by the corporate, whereby, for example, you go in a country, you are in a country, but you don't have access to the clearinghouse. So what you're going to do is just go via a third-party bank, but there is another element in there in the chain that you need to manage. And that third-party bank will manage all of your transactions, but completely not seen by the corporate. It's another type of co-petition, if you want. So we see that really more and more happening because the corporate will come to the banks, will come to the system vendors saying, we want to have one solution that's going to cover all of our needs, and we want to have one counterparty risk that's going to cover all of our needs for that typical region.